Business relationships, vendor referral policy, RESPA, where compliance meets everyday practice. As we continue building from assistance, teams, and operational structure, we now move into one of the most scrutinized and misunderstood areas of real estate: business relationships and vendor referrals. This section ties directly into everything we have discussed so far: supervision, compensation, and risk management. In real estate, relationships drive business. Brokers and agents regularly interact with lenders, title companies, home inspectors, contractors, and other service providers. While these relationships can improve efficiency and client experience, they also create significant legal risk under the Real Estate Settlement Procedures Act, RESPA, codified under 12 U.S.C. paragraph 2601. RESPA exists to protect consumers from undisclosed financial arrangements and improper referral fees. The law is very clear: agents and brokers cannot receive anything of value in exchange for referring business related to a real estate transaction involving federally related mortgage loans. Example: an agent consistently refers clients to a specific lender who, in return, provides the agent with gift cards or marketing support tied to those referrals. This may be considered a RESPA violation if there is a quid pro quo arrangement. In 2026, enforcement remains strong, and regulators are paying closer attention to marketing arrangements, co-branded advertising, and digital lead generation platforms. Entities subject to RESPA. Who must comply? RESPA applies to a wide range of parties involved in residential real estate transactions tied to federally related mortgage loans. This includes real estate brokers and agents, mortgage lenders and loan originators, title companies and escrow agents, settlement service providers. If a transaction involves financing connected to a federally related mortgage loan, RESPA applies. Cash transactions may fall outside certain RESPA provisions, but brokers should still operate under the assumption that compliance is required in most residential transactions. Example: a brokerage partners with a title company to streamline closings. Even if the relationship is informal, any exchange of value tied to referrals must comply with RESPA. RESPA prohibitions: what you cannot do. RESPA Section 8A prohibits giving or receiving any fee, kickback, or thing of value in exchange for referrals of settlement service business. This includes direct payments for referrals, gifts tied to transaction volume, marketing arrangements that are not proportional to actual services provided, desk fees or rent that are disguised referral payments. Additionally, RESPA Section 8B prohibits fee splitting or unearned fees, charging for services that were not actually performed. Example: an agent receives a $500 marketing fee from a lender for each closed transaction. If that payment is tied to referrals and not actual marketing services, it is likely a violation of RESPA. This is one of the most common violations seen in the industry, and often occurs because agents do not fully understand the difference between legitimate marketing and illegal referral compensation. Exceptions to RESPA's prohibitions. What is allowed? While RESPA is strict, it does allow certain business arrangements when properly structured and disclosed. One of the most important exceptions is the Affiliated Business Arrangement, ABA. Under RESPA, an ABA is permissible if the relationship is fully disclosed to the consumer. The consumer is not required to use the affiliated service. The only compensation received is a return on ownership interest. This is why the Affiliated Business Arrangement disclosure form is so critical in Arizona transactions. It ensures transparency and protects both the consumer and the brokerage. Example: a brokerage has an ownership interest in a title company. The agent refers a client to that title company, but provides a written ABA disclosure and makes it clear that the client is free to choose any provider. This is a compliant arrangement. This ties directly back to broker supervision. Policies must ensure that ABA disclosures are used correctly and consistently. Examples of permissible activities and payments. Understanding what is allowed under RESPA is just as important as understanding what is prohibited. Permissible activities include paying for actual services rendered, e.g., legitimate marketing services at fair market value. Co-marketing arrangements where each party pays their proportional share. Educational events or training not tied to referrals. Normal promotional activities that are not conditioned on business referrals. Example: a lender and real estate agent share the cost of a marketing campaign, each paying their fair share based on actual expenses. There is no requirement to refer business. This is generally permissible. The key is that compensation must reflect real value and not be tied to referrals. Examples of prohibited activities and payments. Now let's look at where agents and brokers often get into trouble. Prohibited activities include receiving gifts or incentives for referrals, entering into agreements where referrals are expected in exchange for benefits, accepting free or discounted services tied to transaction volume, charging fees for services not actually performed. Example, a title company offers to pay for an agent's client appreciation party in exchange for referrals. Even if informal, this creates a quid pro quo arrangement and violates RESPA. Another example, a lender provides free office space to agents in exchange for consistent referrals. This may be considered a thing of value tied to referrals and could violate RESPA. These situations often arise from good intentions but can quickly turn into compliance issues if not properly structured. Section Review, bringing it all together. This section reinforces a critical theme of this course. Relationships must be transparent, documented, and compliant. Business relationships are essential to success in real estate, but they must be handled carefully to avoid legal exposure. From agency to supervision to financial reporting, we now see how everything connects. Referral relationships impact compensation, disclosure, and broker oversight. If any part of this system is unclear or improperly managed, it creates risk not only for the agent but for the entire brokerage. As we move forward, the next section will continue building on this framework by focusing on advanced risk management strategies and how brokers can proactively prevent violations before they occur. Online discussion. Why is RESPA considered one of the highest risk areas for brokers? Answer: because it regulates financial relationships and referrals. Violations often involve compensation, which can lead to significant penalties and legal exposure. What makes an affiliated business arrangement compliant under RESPA? Answer: full disclosure, no requirement to use the service, and compensation limited to ownership interest. Why are informal agreements between agents and vendors still risky? Answer: because even informal or unwritten agreements can be interpreted as quid pro quo arrangements, which violate RESPA.